Happy Tuesday. We welcome you to Investing Master Series. My name is James Boyd. Today's date, August 12th. My gosh, it's becoming a little cooler in Salt Lake City. It's almost getting that football time of year. You're a fan. Let me know who your team is. We're all undefeated right now, which means we're all winners. That could change. All right, we'd like to welcome everyone here. Just real quick, you can follow me on X. My handle is at James Boyd CS. We do post educational examples and also announcements on X. And also, we will be posting our schedules there daily, so check that out as well. Just real quick, as we get started, we'll welcome Sharon, Kevin, Dean, Buenos Dias. I think I said that right. Bill, Christopher, Josh, John, Amanda, JP, WW, GH, and many others. Welcome and good morning to all. Also, just real quick in the chat, we have Kevin Horner with us. Kevin and I teach the ETF class on Friday, so make sure you check that out. That's at 9:30 a.m. Eastern. And also, Kevin teaches many webcasts throughout the week. He also was at the in-person event in New York City and will be there in Chicago. So feel free to join us live as well. Now, just real quick as we get started, remember that options carry a high level of risk, not suitable for all investors. Also, when we talk about options, we will kind of talk about kind of the strategy of them, whether they're defined risk, is it something you would consider, but we'll also compare and contrast options to stocks. Also remember the information here is provided for general informational purposes only. When we talk about examples, they will be done on the paper money software application for educational purposes only. Investing involves risk, and also when we talk about without taking risk, there's no upside, okay? So we have to kind of have an understanding of what is the risk that the investor is willing to take, and then what could be the potential reward, okay? But that's just a part of investing. What is the risk? Now, also remember that short options, we'll show this here today, those could be assigned at any time. We'll talk about what that really means, and we have one example that we could discuss in detail, which we will. Now, also remember that we'll talk about market conditions. We're going to talk about new and existing positions. So when we talk about the Investing Master Series, it's really kind of talking about all of it, whether it's technical analysis, fundamentals, options, how do you build a portfolio, manage a portfolio, and even a stock portfolio. With that said, let's go ahead here and hop right in. So I don't know how you like to see the information. I like to look at a list first, especially if I just woke up. And so if we look at a list, and I just kind of put this by which list I look at first. The first list I look at is futures, so that's why you don't see it. Second look I look at is indexes. Now, obviously, indexes would not be open unless they are 9:30 a.m. Eastern. That's why I look at the futures first. But market's open, so here we are. SPX sitting here at 46 to the good. Okay, we'll show where that is on the chart. 0.7%. NASDAQ actually sitting here about 160 plus 0.7%. Russell up 1.9%. Some of you like small caps. And you're going to see that the Dow Jones, a healthy 478, about 1%. Semiconductors, Kevin, okay, 2%. Okay, now, what's kind of getting pushed down a little bit? Dollar's getting pushed down a little bit, 0.3. You got gold down 0.4. Now, again, this is kind of where it's like a teeter-totter, right? If you get, let's say, the SPX going to the upside, people are chasing performance in stocks, right? Maybe something, let's say, that's gold, etc., that's maybe a little bit more defensive in nature, perhaps, might not be going up as much. It's gotten pushed down a little bit. And what you're going to notice is if they're chasing the returns over here in the NASDAQ, SOX, the whole nine yards, gold might underperform a little bit. If this area actually goes down, this area, kind of precious metals, things like that, they tend to be a little area, a little safe haven. Doesn't necessarily mean that doesn't have volatility, but that's kind of the idea. And so we're seeing a little softness there. So just real quick, let's kind of show what these look like, fast fire through them. This is what the S&P looks like. Tell me what you see on the chart. Now, I want you to imagine friend calls you up and says, I'm really not sure. The market looks a little rich, okay? The market looks a little overvalued, right? Well, going back to what we talked about 2 weeks ago, we talked about the gap down open price, and what you're going to see is we have tippy-toed all along the 10-period moving average. Okay, now some investors, they can't control themselves. When they see the intraday price action, just tippy-toeing. Oh, goosebumps, okay? tippy-toeing, went right down to the 10-period moving average, push right back up. That's why we have the 10-period moving average, because if we're going to have momentum, that moving average is probably going to act like potential support. That could also be an area where investors try to set up buy limit orders and try to buy on the intraday price action. Now, what's interesting is when we have this large red candle right here, okay, this should have been a line of resistance. That line of resistance did not last very long. Is that a bad thing? Just say no. And what you're now going to notice is we've smashed, repeat, smashed our way higher. So a lot of times when we kind of have fear and things like that, the fear doesn't last forever, just like a rainstorm, tornado, you name it, earthquake. It just doesn't last forever. I mean, it knocks it down, but sometimes investors use those opportunities to get in. And here we are. So S&P, if we have the S&P almost at new highs, now everyone say out loud, new high, new high, new high, okay? We're not even that far. We're, 4 points away from a brand new high? And I think we've said that, I don't know how many times this year. The answer is a lot. The S&P is a new high. A lot of sectors might be pushing. Now, here's the question, okay? Where might an area be to invest in? Where? What sector? Now, option number one, the investor might just, let's say, buy the index itself. The second thing is we talk about domestic versus international. I will say this. We talked about Japan on Friday. Has anybody seen Japan? Keep an eye on that, okay? So it's not just here in the U.S. We're seeing those other international markets, equity markets, bullish, okay, getting a little push here as well. So don't act like it's just the U.S. markets, because that's simply not true. Now, if you look at the NASDAQ, which has been leading, Groundhog's Day again, brand new high, okay? And remember, we've been watching the tippy-toe off the 20-period moving average, tippy-toe off really the 10-period moving average. And I think we beat that drum to death, okay, as far as using the moving average as support. Red candles are not fearful unless they have actually, well, if we have red candles, that's fine, as long as they're above the 10-period moving average, okay? If they're above the 10-period moving average, it could just be some slight pause in momentum. If the price starts going down below the 10-period moving average, now we're getting the softening, okay? But when we had the red candle, went up the very next day. Red candle went up the next day. And I'm going to tell you, if there's anything I'm going to do at this company, I'm going to hammer that home, that the red candles are your potential friends. And the biggest actually thing is, if that stock is above the 10-period moving average, there could be a trend, there could be a momentum. And so we got to learn to embrace that. So many people speak out of both sides of their mouths in terms of trends and momentum, and you don't even know at the end what they just said. Okay, I've been doing this for 25 years, and I've seen that for 25 years where investors don't really commit. Well, it could go up, it could go down. Wow, that was extremely helpful. Appreciate that. A lot of investors say, look, this is the setup we're looking for, which is the foundation, price above the 10-period moving average, and we're looking for short, shallow pullbacks. Now, when you actually take a look at that, the Dow Jones itself, Dow is firming up a little bit. We want to go back to the question now. What sectors are getting a push? Well, let's go back to the market watch. Well, if the first list was futures, which we're not talking about, second list was indexes, we're going to go to the third list. And now what you're going to see is the third list is sectors. Now, if you take a look at sectors, now we get a little sense of what's cooking. Now, you also got to think about, we're just kind of taking a look at the sentiment now. Okay, right now. Now, when I look at this list, what are we looking at first? Well, what am I looking at first? I'm looking at percentage change for today. What do we see up top? What do you see? Well, we got the Dow Jones Transports. Now, here's the thing with the DJT, I don't usually like to look at that because I want to actually look at I want to look at a product that actually tracks stocks that has an unequal weighting. Join us on Friday and you'll actually find out what that symbol is. We talk about it every week. But the biggest actually thing is some might use a DJT as a proxy for the transports. Fine. But if we could, we would just actually throw in this sector that we normally talk about on Friday. So transport's leading. Now the question has to become what? what's leading in the transports? Is it rails? Is it trucking? Is it airlines? What is it? Now, I just want to kind of ask a question just real quick. What is it? Which industry group is leading? Now, it was kind of hard not to see it, okay? Which industry group is getting a little push? Now, semiconductors, number 2. We got communications, actually, number 3. Financials getting a push. And holy, Goldman Sachs this morning. Got to talk about that. We also got Morgan Stanley getting a little push. Are there any of these that are actually showing a recent crossover? Yeah, Dow Jones, the Dow Transports with a bull fleeg. We're also seeing that crossover on the semiconductors, okay? And we're also seeing the crossover here today on communication. There's a lot of fresh crossovers. Now, here's what happens every time. The investor says, I'm looking for a crossover. We see a crossover, yeah, but how do we know it's going to go up? How long can we say that before we have to realize there's risk with every entry? And that's the thing. There's risk with every entry. Now, what I want to do just real quick, if I can, let's go back to visualize. Market watch, visualize. So we said transports. We said communication. We said financials. I want to go to this visualize for just a sec. Oh my gosh, that's a lot of green. Where's my sunglasses? The biggest actually thing is when you take a look at this, a couple things in communication services. Meta is still kind of that little Kentucky bluegrass green. We're seeing financials. There's a couple names here that we talked about. There was a small company called BlackRock that we've talked about, these asset managers, right? We're seeing a little Goldman Sachs get on the high horse here today. We need to talk about that because it's in both accounts, the paper money account. Morgan Stanley getting a little push, and a couple of these other financials like C getting a little push as well. Now, where's the transports? Well, when we look at transports, we're going to really be looking at, let's say, industrials. And you're now going to see that if we said in industrials, what neighborhood do we see? And you're going to see a little section down here called Delta and United Airlines. See how they put that down there like we couldn't see it? We can. The other one we want to talk about today is Uber, okay? So Delta and UAL getting a pretty big push here today. So this kind of becomes a visual watch list, okay? Now, let's kind of go into this. I'm going to take a quick look at some of these. We look at Dow Jones, Dow Jones Transports. We are getting like a little tilted up bottom. Keep an eye on that. We're going to come back to Delta and UAL in just a moment. Now, when you take a look at, let's say, the dollar sign, the communication services, what does that look like to you? Now, we can't say that this is brand new. We can't say that, okay? Now, why do we look at the sectors? We want to know, number one, the investor could just try to buy the sectors. That's obvious point number one. The investor doesn't have to buy the individual stocks. We know that the individual stocks could be more volatile than the sector. So the investor might say, look, I don't know which one's going to go up. I'm just going to buy the sector. That's option number one. Option number two, the investor says, you know what, James, I think I'm pretty good at picking individual stocks. I'm going to try to buy some of the stocks that are in the sector, that's what we're going to show. Now, the other one, if I go back, that's hitting a high, you go back and look at the financials. And what you're now going to notice is when you take a look at the financials that have been a little softer, we're starting to show we are showing a moving average crossover. So we are in step number 2. 10-period moving average went green, okay? We crossed over yesterday. That red candle lasted only one day, only to fire back to the upside. And if someone says, I'm waiting for confirmation to see if that 20-period moving average turns green, it's not yet. But if someone says, James, I get on an entry number 2, it's right now, okay? I mean, if that's what they're saying their criteria is. I want to start with financials for just a moment, okay? Now, the one thing I want to kind of bring up is I had a good friend of mine Facebook me yesterday, says, hey, I want to learn about how to trade options. And he said a family member had actually watched my class yesterday. And how do you learn about it? How do you learn about options? Interesting question, because I kind of feel like that we do that all the time. But I just want to make sure we're 100% clear with what we're talking about today. We're going to talk about stocks and options. We just kind of showed how to find them a little bit, right? From a list and or a market watch. And the biggest thing is, if you take a look at this, if we kind of went down and said, why are we bringing this up? Well, I need to actually bring this up first. This right here is, now we're going to talk about an existing position, but then we're going to talk about adding a new position. So what is that position right there? We got two puts. The strike that is the highest was sold, okay? And the strike that is the lowest was bought, okay? There is your classic short put vertical. Okay, now, why do we talk about verticals on these bigger dollar stocks? Simple answer. So the investor could try to ride the trend and just not have as much capital invested, okay? So that's number one reason. Now, if we're doing a put spread, the number one reason why the investor is doing a put spread, okay, short put spread, is they're saying, look, I want to trade probability. Now, when you say a put spread, it could be a long put spread, debit, short put spread, credit. Why did you do a short put spread? Well, short put spread is a bullish strategy, okay? So that's why it was a short put spread. Now, on this trade, what you're going to notice is with 3 days remaining, this one is pretty much gone, okay? Now, the investor might say, I'm going to wait, an extra 3 days and try to get that last nickel. Well, we're not going to choose that because we want to do all the trades in class in the webcast. That way we can learn about options. So the investor, if they have a position, they want to set up a new position, that would be what we call rolling the position. Just exiting what you have and entering a new one. Let's do this. We're going to right-click on that, create closing order, buy that back. So what happened is you got in for a credit, okay? And now the investor is saying, I'm going to give some of that initial credit back to try to realize what they have. You got to understand on the way out, in this case, since there's two contracts, there's a commission, okay? Now what you're going to see is we're going to give back 17 cents per contract, got two of them, and it's $1.30 per contract, and since we have two contracts, it's $2.60. We're going to send the order. Now, what we're going to do in this case is, what does Goldman Sachs look like? Okay? Now, Goldman Sachs looks like the following. When we look at Goldman Sachs, and we're going to do Goldman Sachs, and we're also going to do Morgan Stanley. Now, if you take a look at this, what you're now going to notice is a little horizontal resistance. Some of you call it resistance. Okay, that's fine. I'll take that. And what you're now going to kind of notice is there's been some upward or some higher lows over time. Now, if we kind of went back and look at this and kind of said, let me zoom in a little bit, there was a gap up in the price. The gap up, that's why I teach close higher gaps or gaps in general. Man, this gapped at 725 and it just shot 20 points in the first hour and 45 minutes, okay? Now, what we're going to show in this case is we're going to roll the position. We're going to go back to the paid money account, trade tab. We're going to actually bring up GS. We're going to go to the September expiration again. Now, Bill calls this rinse. And Bill, what do you call it? Remind us just real quick so we can remember. Now, if you take a look at this, we're going to go down to, now, someone could visually, on the chart, where they could say, where do they think the support is? They might say support's at 715. They might say support's at 725, okay? They might say, look, I think we're going to stay above 731. Whatever strike you sell, the investor is saying, I'm going to sell a strike where I think the price could stay above. We're going to go back to that trade tab. If the investor said, look, I think it could stay above 720, that is going to be a 730, that's going to be a 720 strike with a 31 delta. Now remember, delta kind of a dual meaning. The probability of the stock being below the expiration at the strike price, we're talking about the put here, okay? So as of right now, there's a 31% chance it could be below the strike. Everything sums to 169% chance we could be above, okay? Now, we tend to hear what we want to hear. Man, I'm talking to you, okay? Joking. Could be ladies, too. Now, it's a 31% chance it could be below, okay? Now, I'm thinking, oh, it's almost a 70% chance I could be right, but I could be wrong, okay? Now, that 31 is also saying the stock goes up or down $1. The option moves by approximately 31 cents. So I like to think about is a conversion value. this, or translation. Stock goes up $1. How much does it move the options by? 31 cents-ish. Now, what we're now going to see is we're going to sell, we're going to right click on that bid, sell, and we're now going to go to, let's say, the vertical. And if we do that, it's going to give us the $5 wide strike. Don't have to do the $5 wide strike. If we're trading, let's say, a smaller account and we have a smaller amount of risk that we could take, like in the margin account, we're going to do one contract. And if we looked at this, if we lost $355 of a $35,000 account, that's 1%. That's what it can take. However, if we went into the single to multiple accounts, and the IRA that's sitting at 112-ish thousand could take, let's say, $1,000 or $750, we're going to do one contract in the margin and two contracts in the IRA. Okay. Our thinking is, if it's good enough for one, why isn't it good enough for the other? Okay. Now, sometimes that might not be true. Maybe the smaller, how small is the smaller dollar account? We're using the margin as a smaller dollar account. In the IRA, I mean, 112,000 as we're going to call it a bigger dollar account. Might not be bigger dollar, but you get the gist. A little difference in value. What we're going to do is trade number one, we're going to send that order. Now, the one thing what we need to do is to kind of show you this. I did not make mention, but I will show you now. When you look at, let's say, just real quick, GS was also in, it was what? One contract in the margin, but in the IRA, okay, there's two contracts. Now, what's kind of interesting is that's the position that we had on, okay? And the position that we just added to, that it's going to be even on top of that. So we don't have anything there we need to do, but I just want to kind of show you that was working from before. Okay. Now, what I want to do is I kind of have to point this out for just a second. I want to go back to it just real quick, a stock position. Now, whenever you attend one of my classes and I expand the position like this, like open it up, that means I want to talk about it just briefly. Now, in managing a portfolio, it's not just like option positions probably all the time. You might have some stock positions. The reason why I brought up this to bring this up is we've been looking for, this is shares of stock. Just briefly, we're going to pull up the charts. And what I noticed this morning when I was kind of just doing due diligence, right? I looked at the chart and I said, hey, on Microsoft, you're going to notice that the old stop was sat right here about 507.30. In this little pop to the upside and a little consolidation, the price never went down to the white line, the red line, or the yellow line. Now, if you said, James, I'm not familiar with what that white line signifies. The white line is really an 8-day low. The red line is a 10-day low. And what you're now going to see is the yellow line is a 20-day low. Now, kind of a good thing, right? If all of a sudden these days lows, they increase, if we're using a stop off the white line, an 8-day low, and it's pretty much coming down to that one right there. And that's why the white line is right there. So being able to kind of see the lines over time, it kind of allows us to see how volatile has the stock really been over time. If the investor was just moving up stops off intraday lows, how successful would it have been historically? That doesn't mean it's going to do that in the future, but it kind of gives us a gist of how volatile the stock has been. So what we're going to do right now is we're going to move the stop up. Now, we don't have to go back to the monitor page or whatever. We can just click on that right there. Do not click on the X. You click on the X, you're going to cancel the stop order. We're going to just click on where it says minus whatever for how many shares we have, STP for the stop. Left click on it, drag it up, and we're going to move it to there. Now remember, the stop is not saying that's exactly where it's going to sell, and we've locked in profit. That's not true. A stop is a trigger to sell, an order to sell, but it doesn't specify or state where it's going to get filled at, because we don't know where it's going to get filled at. It's a trigger to sell. We're going to have to see where does it fill. Now what we're going to do is we're going to send the order, and I'm going to go back to that right there, and I'm going to close that position. One other position I just want to bring up just really quick is this one. Now, AM was really the gold stock. And we talked about this. I just want to kind of point this out, and I want to give you an option. You're going to make a decision. No, I don't. I don't like to make decisions. You realize that most millionaires like to make decisions? You realize that's probably how they got there? Think that through, right? Successful people tend to set a goal and they make a decision in a series of decisions consistently over time, focused effort to try to get to a goal. They make a decision. And what I always kind of say is if you don't make a decision, you still made a decision to do nothing. Now, I could have a knowledge level of a 10, but if I did nothing, 10 knowledge level, 0 application, 10 times 0 is 0. So don't want to go that route. Someone else could if they want to. But let's kind of take a high knowledge level and then apply, make a decision. Now, if you take a look at this, if we got in at 120 from a short put that became shares, and we have the 135 call. There's $15. We said this last week, okay? But we also got the premium of 263. Now, I don't know about you, but something, it's just like, okay, so if we look at the max gain, 1763. That's the max gain. When we look at the position now, we have $1,142 of the 1763. So when I ran the numbers today, we were at 63.7%, meaning we could actually make about how many more dollars? 1763 less 1142. We could try to make $621 more dollars, but we would be giving back. That doesn't feel good. I don't like to give back anything. Plus risk. Okay? Risk of how much you bought the stock for. Now, I don't know about you, but that's like a 1 to 2 or worse. Okay? So you would give back all the profit. How many of you don't want to give that back? And then you'd be risking money on top of that. So what happens is the reward remaining $621, which is just the difference between this and this, it starts to get smaller and smaller and smaller. Now, you got to remember something is that's a 63% return with 38 days remaining. Now, some people say, James, if I ever get 80% ever, I would consider taking that off the table. Well, if you're like 30 days, 40 days plus, and you're over 50%, that's like getting 80% return, okay? So what I'm going to do is I'm going to close this position down, okay? So the profit's sitting in the hand. It's unrealized. And what we're going to try to do is we're going to try to close that fist. And we're going to try to grab it. And we're going to make a decision, and we're going to like it, okay? We're going to right-click, create closing order, sell, okay? And now what you're going to see is we're selling those shares of stock, but we're buying the callback. Now, when you buy the callback, what it's doing is it's really saying, look, I no longer want to be obligated to sell those shares of the stock at the strike price. Why? Because I don't have the shares anymore, okay? And what we're now going to do is going to go confirm and send the order. Now, I just need to speak to just really quick, if I go down to these short puts, and if you said, James, what is a strategy that you tend to focus on quite a bit and why? Well, cash secured puts is really trying to buy the stock at a strike price from the time the trade is placed until expiration. So if we went down to, let's say, now I want to just double check, AM, that did get filled. But if you go down here and look, we sold the 130 puts, sold the 120 puts, and the one that's a little rich with potential gains is really this one. And if that's at 72%, okay? Now, sometimes people say money doesn't buy happiness. You could say whatever you want, okay? Now, the biggest thing is sometimes money does kind of make people feel like they have a little bit more options. I like to think of it as like there's more air, okay? I don't think anyone wants to hyperventilate by not having enough air. That's why some people, you determine what is maybe the financial goal for yourself, where you say that's good, that's what I need, that's what I want, and you're shooting for that goal yourself. What we're going to do this is we're going to right click on this. It was sold for $390 initially, and it's at 107. What we're going to do in this case is we're going to buy it back. Now, what happens is a lot of investors are like, no, 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 no. I want all of it. The problem is we have 280, okay, of the 390. And when you look at the math of that, then you got to ask yourself, this is called the IQ test. If you have 280 of 390, that means you could try to make another $110, but you could give back the gain now plus the risk. Now, I don't know what that really number is, but it's a minimum ratio of 1 to 3 or worse. When you started getting those ratios, that's probably saying that the investor might say, James, I want the check. I want to just get out of the position and try to rinse and repeat again. Create closing order, buy it back. So cash secured puts are an important strategy because sometimes the investor is trying to play direction, time decay, and volatility contraction. Cash secured puts are also very important because sometimes you don't get price appreciation, but you want that time decay. Now, speaking of time decay, what we're going to go ahead and do is we're going to look at 3 positions, and we're going to fast fire some. Now, what I'm going to do is it also says illegal right there. Why does it say that? Well, because what it's doing is, we'll just double check this. I'm going to go ahead and just close this position out right there. If I can, create closing order, sell. And what I'm now going to do is, if I click on that, yeah, it's saying illegal. I will try to sell that. I think something's tying it up, and I'll double check. Oh, it's actually, I can see what's actually going on here, right here. Somehow that, so by the way, you ever realize, so this is in an IRA, okay, and it's short. Can you be short shares of stock in an IRA? The answer is no. So how do you get out of that? We buy them back. If we're negative 100, think like a credit card. Buy American Express $100. How do I get out of the trade with American Express? Well, give them the money back, okay? Plus some interest if there is any. Now, what you're going to notice is they're going to buy those back, confirm send. It's going to shut that position down, and now what we're going to try to do is create closing order there, buy that back, and now we're not going to see illegal. So that's why it was showing that. Okay, send the order. There it is. Now, let's practice an example of a stock that might be showing a little bullish momentum. Okay. Now, I want to kind of just see if there's any questions just here real quick. And I want to start with the stock. Let's go to UAL for just a moment, okay? Now, this is kind of an unusual setup here, okay? Now, what I want from you is I want you to say, wow, James kind of talks about this one, or everyone say together, uno, okay? Dos, okay? Tres. And what you're now going to kind of notice is the investor gets to choose one is kind of more aggressive. You might have red hair like I do, okay? And you're Irish. You like to get in a little early. Some of you said, nah, James, I'll kind of take that moving average crossover or the 20-period moving average going green. And the third is the moving average crossing over or going green. Sometimes those might be a little different in terms of timing. In this case, we had the moving average crossover come first. So that's number 2. Now, the biggest actually thing is, if you take a look at this, where was the entry? Well, depends on how aggressive the investor wanted to be. Let's say the investor said, James, I don't want to get in until day number 3. It was right there. It's classic moving average crossover. Now, today, what you're now going to notice is, yesterday we went down for a little bit. We hammered yesterday. Red candles are not the enemy if the price is above the what? Say, give it back to me. What do we say? The red candles are not the enemy if the price is still above. I feel bad for the person if they're not playing this game because they're going to keep making the same mistakes over and over again. And they're going to say, my portfolio is like paper money accounts. It's not going anywhere. And I don't know what to be even practice on. Well, hello, that's what we're talking about. Well, remember, the red candles are not fearful if their price is still above the moving average. Today, the price gaps to the upside. Now, how did the investor know the stock was going to go up higher and higher? You didn't know that. But I don't think necessarily a gap to the upside is a bad sign. I mean, do you think it's a bad sign? Okay. Now, if we take a look at this, let's say the investor said, look, I want to sell the put. I mean, the stock moves 9%. If the stock goes up 9%, the volatility goes up too. Now, why do we care about that? Well, the investor might say, well, the higher the volatility, the bigger the option premium. Bigger the option premium, the lower the break even. Now, if I were to ask BJ, Lena, Dave, Don, BJ, Jackson, Gina, where do you think the support level is? Where do you think it is? Calling all technicians. Where's my phone? Okay. Calling all technicians. Where are they at? Technicians, pick up. Well, if we take a look at this, some technicians might say, you know, James, I'm kind of thinking about where we kind of had a little consolidation. James, I'm kind of thinking about maybe where we gapped up from. So you got about 92.88-ish. Okay, now John actually says 91. Okay, so if we're within 1%, we're in the same vicinity. Kelly says 92, and Eduardo says 92. So a lot of you saying 92. So let's kind of show this. If the investor says, look, I think the price can stay above the 92, we're going to go to the paper money account. We're going to go to the trade tab. We're going to type in that case, we're going to pull up UAL, okay? And we're going to look at the September expirations. Now, on those September expirations, the monthly options, we're going to say which strike is the closest to the potential support. Now, here's the deal. We could think that it's going to stay above the 92. We don't know. So that's why the investor wants to be compensated for the risk. Compensation for the risk is known as premium. Okay? Now, the closest thing we can get to that, we don't have it at 92. We got a 92.5. And the probability of the stock being below the strike, 32. Probability of being above the strike at expiration is 68. We're going to right click on that 92.5. We're going to go sell and we're going to go vertical. Now, wait, why are we going sell vertical? Well, we're going to sell vertical because if we're in the IRA account, if we sell the 92.5, they're going to want to set aside more capital to be in the position for the risk if the stock went all the way down to zero. Now, by the way, so when someone is actually doing stock trading, could cash secured puts be kind of a way to try to buy stocks? The answer, of course. Could selling the put or cash secured put, could that be a way that the investor might try to practice what they know in stocks and bridge their understanding to options? Yes. Okay. Now, why do we have a paper money account? So you could actually practice the trade strategy and see if it's something you would consider. So if the investor just gets to keep the premium by themselves, it was just a cash secured put. If the investor is assigned to buy the shares at the strike price, it becomes stock. And if the investor owns a stock, they could actually do what they want with the stock, check the liquidity. They might even say, now that I own the stock, I could do a cover call. So it kind of morphs into some different things that the investor might try to do. Now, what we're going to do is we're going to buy the put with a delta of 10 or less. Which one is it? Well, you got that one, this one. Okay. Now, what we're going to do is we're going to buy a put with a delta of 10 or less, and we're going to buy the 75. By buying the 75 put, it makes it where it's not having to set aside as much capital. And what it's doing is it does reduce the credit somewhat because we're paying about 35-ish cents for the put. But that 35 cents might be the most interesting amount of money invested because instead of making the max loss bigger or the buying power bigger, which is the money set aside to do the trade, that might be a decent investment for some investors. Now, the other con about that is it does take another 65 cents to buy the contract. But you compare and contrast for yourself. Would that be something you consider? What we're now going to go ahead and do is send the position. Now, one thing I want to kind of show just real quick is the first trade we did was Goldman Sachs. Second trade we actually did was UAL. I do also want to point out if we went and looked at DAL, same type of setup. Now, I know that some of you, I live in Salt Lake City, so we're Delta, okay, or Delta Hub. Some of you are like out of Chicago or near there, maybe Denver, and you're like, no, I fly United Airlines, I'm more comfortable with that, whatever. Now, the one thing I will kind of say on Delta Airlines is this is kind of smashed up near this 59.08. Now, you got to ask yourself the question, what investors would be pushing it up that hard if they did not think that 59 could become like, well, a thin sheet of paper and that the price could poke through there? Now, what I'm going to do is I'm going to show something a little bit less than this in this example, faster, because we can. I'm going to go to Delta for just a second, and I'm going to kind of do something that has a lower strike. Does the investor always have to do something with the 30 Delta? No. Let's say the investor says, James, I'm going to sell something like the 52.5, and I'm just going to sell it by itself. Let me show you the difference. If we sell the 52.5, it has a lower probability of being below the strike price. Lower probability, lower premium. Lower premium, higher break even. Okay? There's some people that do this, and they might do it with a higher number of contracts, but there's risk with that, like anything. Let's say the investor says, I'm going to do Delta, and I'm going to try to just grab that premium, and there's a lesser chance of the stock being below the strike. But there's still potential, though, even though we said that, of assignment risk, which means someone could assign us to buy the shares at the strike price. If they do that, the paid money account buys the shares, but it gets to keep all of the premium. So the investor with knowledge would never sell puts if they did not want those shares. If they didn't link those two together, it means they didn't fully comprehend the strategy. What we're going to go ahead and do is say confirm and send, and there it is. Now, when you do not buy the put as well to the downside, notice the max loss goes up because they're saying the risk is all the way to zero. And also what you're going to see in this case is the amount of money set aside to be in the trade to enter that position is known as buying power effect in this case. And you're now going to see it takes more capital to do the trade, which is now affecting the return on the investment. Now, the investor knew that. Since I showed you that, you could say, I'm just going to go ahead and sell the 52.5. And what I'm going to do is I'm just going to buy a put way out of the money. I don't ever think it's going to become worth anything. But what they could do is say, look, I'm just going to buy that put down at 42. So if this stock went off the rails to the downside, now it's going to make it where, yes, the credit is not as high. Max loss is not as high. Buying power is not as high. Note the higher commission. You get to choose it. Is that extra 65 cents worth it? Would you be willing to take a little bit less profit potential to cut the max loss? That's for you to decide. I'm going to go ahead and send that order. Now, the other one I want to come back to, and I want to fast fire through a couple stocks that are getting a little bit of a push. Morgan Stanley. Now, again, the foundation, and I just want to make sure we're clear on this. What is the foundation for all the trading examples that we show? What's the foundation? What one thing is it trying to actually do? Anyone tell me that? Now, if we take a look at this, I'm going to zoom in, okay? And we're going to go back to that one foundational practice. Looking for a stock above a 10-day moving average. Okay? Now, we can go into why, but we've already hit that. Now, Morgan Stanley, what you're now going to notice, if we look at a 3-year weekly chart, this is what the trend is. It kind of really has, and I'm interested in your technical analysis, we had a prior high, and then we fell down. And it was a pretty quick descent to the downside. Then it went up quite a bit, had a little pause here, a little run to the upside. You might say a little cop, okay? And a little push. And what you're now going to see is a little resistance, and that resistance started to become a new level of support. Calling all MACD investors. When the MACD does not go below zero, it's telling us that the price held the majority of the momentum without having the MACD down. Is that a good sign or a bad sign? That's a good sign, okay? Guarantee that it's going to go up? No. But if that MACD cannot go into the red, some investors like to see that setup. Now, the last trade we're going to do here is, let's say the investor says, I want to buy the shares of the stock and I want to set my stop kind of like below the middle or where the moving averages are. Well, if I said that moving averages are right around 142.39, last trade, this is the fourth trade, 142.39 less 2% in closing, 139.54. Okay. Now, what I'm going to do is I'm going to cut this. We're going to keep it. Nope. We're going to have to cut it down to probably about 75 shares. 75 shares will get it to the allocation that it could be. We're going to go stop day GTC. That would be our final trade. This is a stock trade. Why does someone buy the stock? Well, because they want to have a higher sensitivity to the direction. They're thinking they could be right on the direction. They want a fraction of the move. They want that dollar for dollar up or down movement. Okay? I'm out of my time here today. Cameron May will be coming up next at the top of the hour. I want to thank you so much for your comments and your participation. Thank you also to Kevin Horner for answering those questions in chat. Reminder that you can subscribe to the Trader Talks channel. And also, I will also post a playlist as well from prior sessions. Join us each week as we do this and actually talk about past examples and new examples as well. Remember that all investing involves risk. Not nervous about the risk, just want to know what's the risk that the investor is willing to take and decide that for yourself. And also understand that you get to choose what strategy, stocks or options that you might consider for yourself and use paper money to practice. This has been the class on the Investor Master Series. Thanks to all of you and stay tuned for Cameron May coming up next. Take care. Bye-bye.